Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. Learn about fix and flip loans, BRRRR financing, rental, fix to rent, commercial, multifamily bridge loans, business loans, and so much more. And now, your host, Beau Eckstein.
All right. Hello, everyone. This is Beau Eckstein, your host of the Investor Financing Podcast. This is episode 4. And today we have a very special guest, a good friend of mine, and also a real estate investor with a tech background. And he's doing some really cool out-of-state investing. And he actually has come up with some amazing models, which I really found to be unique, and I want to talk about that today, but please welcome Bobby Sharma to the podcast. And Bobby's runs a big meetup group in the Bay Area. I think he's got like 5,000 or 6,000 members now, and he's doing events like weekly, and you guys should connect with him. We'll put in the show notes his links to his meetups, but I've known Bobby now for many years, and we've developed a relationship, and we're working on some ventures together. But I wanted to bring Bobby on the show to talk about some different models for people maybe that want to invest, but also want to leverage their risk levels, meaning they want to invest out of state because it's affordable and there's great cash flow, but they don't want to just be a lone wolf out there and buy one rental property because you don't have the leverage with your property managers. You don't know who's going to take care of your property. So Bobby, why don't you kind of just give it like a 2-minute overview of your background and kind of the investing you've done and all the different things you're working on right now, and then talk about your meetup a little bit, and then we'll dive into it.
You bet. Thank you, Beau. So I've known Beau for many, many years, and I actually go to all of his meetups in East Bay. So thank you, Beau. And that's where we connected. And essentially, I've been investing out of state for now about 6 years. And we actually, one of your presenters, Kent Mack, him and I connected. And then since then, we've done a lot of deals together. But one of the things that I was getting a lot of feedback on was, there's challenges with owning real estate out of state. Like Beau, you've done deals in Indiana and elsewhere. It's how hard it is for full-time working people to own real estate, especially if they're trying to do the BRRRR strategy and they've got a full-time job. So we designed a service or a product around people that don't have a lot of capital. They want to own real estate. They'll probably have a very difficult time or challenging time starting out in the San Francisco Bay Area because the price points are so high, or on the East Coast or anywhere on the West Coast. The price points are ridiculously high. So, but we allow them to come in, minimum $25K. We do have a 506B, a sort of an entity set up. So just to give you some technicalities, we did go through an SEC attorney who laid out the structure of the entity and then how it's going to grow, how it can take on new investors, and then to qualify the investors. So, but that's the idea is to allow investors to have appreciation, equity, cash flow, and depreciation. Those are the 4 things that investors care about. At the end of the day, it's your cash on cash return, it's your tax breaks. So we took the positives and then we eliminated the negatives. The negatives are, repairs, calls from tenants, property management, dealing with evictions, dealing with the city, dealing with the handyman. So we took all of those out. We do the property management. We have a full-time staff that takes care of the properties. We're only in Kansas City right now, Beau, and it's Kansas City has been a great market. So If you look at maybe a little bit below the radar, it's not quite the Dallas or the Phoenix or the Las Vegas of the markets, but it's slightly below the radar, but it's done extremely well. But yeah, that's what we have launched, and it's been very successful.
And this might be really good for somebody, not only somebody who wants to be more passive, but also somebody who's just getting started, has some money, but doesn't want to reinvent the wheel. So they go in on maybe invest in the LLC per se, right? And they can get their feet wet about, out-of-state investing. So before they dive in, it's like, hey, I've got 25 grand. Let me put it in. I'm going to get hopefully above average return, which it's proving to your model's proving that. And then they can, kind of understand how the out-of-state investing model works, because it's when I started to invest out-of-state, you definitely take some hard knocks, right? But after a while, you start building your own contacts, and you get the right people in place, and then you can do it on your own, which Yep. I just jumped in and started doing it on my own, which might not be for everybody. But what I like about this, it diversifies. So your average offering, is it just constantly growing, meaning you're just doing one and then they kind of come in when they come in, and then it's tracked by an accountant? You're not doing like several of these kind of series, I would say. You're just doing one, and they can come into this one.
Yeah,
and
exactly.
And it's tracked from the point they come into, which is pretty unique. So I kind of look at it almost like a mutual fund, where you're not just buying one stock, you're buying 20 or 30 or 40 houses at one time. So it's the law of averages, right? You might not get the highest rate of return. You're not going to get the lowest rate of return. You're going to get a solid rate of return based upon the performance of this mutual fund or these 30 or 40 houses. So your risk level is greatly lowered. If there's turnovers, if there's evictions, if things like that happen, you don't just have one property, you have these 30 or 40 properties, which I think is really smart, yeah. Especially because we're at a market cycle right now where we may see a slowdown, yeah. And this kind of definitely lowers risk levels, because as we all know, if you have one property goes vacant, you're not making any money, versus having 30 properties and 2 or 3 go vacant. It's not a huge deal. The portfolio is still cash flowing. Yep. And so I think this really makes sense. I see this model growing for you and growing for your investors as well. So I really kind of want to explore this with you, and that's why I thought we should talk about it today.
Absolutely.
So going forward, kind of what's your vision with this?
Yeah, the vision is, the current entity allows us to raise up to 2.5 million. When we exhaust that, we can launch another similar entity, and then grow that. Our goal is to allow people to be invested. The way we did this one, it's a little bit unusual in the sense that we have no mortgages on these properties. So very conservative approach. Number one, all owned by the LLC, owned by the investors, with no mortgages. So that's one kind of an unusual point. The other is we have full-time staff in Kansas City. So there's no outsourcing of property management. There's no outsourcing of contractors, handyman. It's all done in-house. The vision is that eventually we'll operate this in multiple cities, so that you're geographically diversified. So somebody may want to own in Memphis, somebody may want to own in Atlanta, somebody may want to own in Jacksonville or something. So what we want to do is structure it such that people can come in, put 25 in Kansas City, put 25 in Atlanta, put 25 in Memphis or Jacksonville, but give them an opportunity to be geographically diversified. But that's the big picture. The goal, we set out to raise a certain amount. We exceeded that amount. and we're still having people that are adding capital to the investment. Most people, yes, they want to build equity. They want to plan for their retirement. But most people, at the end of the day, what they care about is capital preservation and cash flow. Equity growth, capital preservation, and cash flow. They need cash flow coming in. And Beau, like you pointed out, if there's 30 properties and 2 are vacant, no big deal. You're still collecting rent from 28 or so properties. So you don't feel if you have a fourplex and 1 or 2 are empty, you're taking a hit. Versus this way, it's spread out across multiple doors. The other thing that's a little bit unusual about our properties is that we primarily focus on Section 8 properties. So typically what we have found in the Midwest is that Section 8 pays pretty well, usually above market. So on some of these properties, the cash flow tends to be a lot better, and we're guaranteed the rent from the Section 8 voucher program. So we've built this to be super conservative, withstand any kind of a market cycle, any kind of an economic cycle. The government, as we know, prints money, so they will not. It's very hard to get rid of the housing voucher program because it's now kind of embedded in our society. So I think we're going to be having this or similar type of programs for a long time.
Yeah, I like this model. And as you were just talking, I was like, okay, how can I do something like this? And this is the idea of the show, is to figure out ways to work together, figure out ways to maximize investing strategies and leverage people and money and different things like that. But kind of my model is how do I set up an entity and bring in investors, right? But go in and kind of buy, fix, and hold initially, right? So if I buy, fix, and hold,
yep.
And since I'm a lender, we do a lot of portfolio loans. So my idea is to have a similar structure, but I go in, I create value on these properties, stabilize them, and maybe it's 1 by 1 by 1 or 2 or 3 at a time. And now all of a sudden we have 20 properties, and then I do a portfolio loan with the hopes of paying back all the investors that put money in. So they're now their returns are supercharged because they get in a perfect model, they get their capital back within 2 years and they're cash flowing the rest of the way. I mean, if I could create something like that for a few of my good investors, because I have a couple go-to where it's like they know, like, and trust me, and I'm like, here's the model, and the hope is by year 2, all your capital or a good chunk of it's already paid back, and then you're cash flowing to life until we decide to either 1031 or sell the properties or just pay tax on the gains down the road or keep them for the next 20 years, depending on that. Yep. Because with the availability of cheap money right now, like our portfolio program, for example, minimum asset value, I think now on our portfolio program, actually, I'm going to look because I forgot. And I think we just changed it. And I think it's important to talk about this, especially with what you guys are doing, your price points, because a lot of our Midwest, okay, so let me just look here. This is kind of good. Okay. I think property values. I know on our single property rentals, minimum loan amount is $50,000 per house.
50K.
Yeah, so we have to have a minimum value of $62,500 if we're doing 80%.
Yep. And does it have a minimum dollar, like a total, like a $1 million loan, or is there a minimum for that?
Our rental portfolio programs go up to $20 million. Like if somebody had 100 assets in Las Vegas or wherever, we could do up to a $20 million loan. But what I'm curious about is on our single rental program, I think our minimum loan amount is still $50,000 a house. So the asset has to be worth, that's what I'm trying to figure out, because this model will get better because your returns could be supercharged by year 2 or 3
Yes.
right? Like if you could model that.
Yes.
Anyway, I'm gonna look into that because I can't remember. But let's say it's 50,000.
Yes.
So the idea for me would be that I want to go in. I might buy the properties. You might be buying properties at 30,000, but putting in 15 or 20, and now you have an asset worth 75,000. So the goal would be to have a fixed up assets worth at least 65,000 probably, right? So when I'm going into a market, I want to find something that when they're fixed, they're worth at least 65,000. So then you same model, you go in with what you're doing, and then now you can have a whole business model, and then you do a portfolio loan to 75% of new appraised value 2 years later, right? And hopefully you get a little bit of market appreciation on top of the sweat equity you put into the property, right? So that would work. But your model is great because it's ready to go. And you can constantly add new assets to it. So I was just thinking for me, because I do a lot of deep value add plays, but also what's good too is you have a lot of inventory already. Right. So you can create these bigger and bigger portfolios as you deem necessary. So that's good because you guys have like 700 assets right now, at least.
650 single family or some duplexes, but mostly single family homes, mostly in Kansas City, St. Louis, Memphis, Cleveland. So in our case, we're not having to go purchase and then rehab a home. We have existing inventory that's performing, and that's what we transfer into the syndication.
What's kind of a rule of thumb you look for on these cash flowing properties? Like, like on the West Coast, we're like, well, if we can get the 1% roll, if I buy a property for $100,000 and it gives me $1,000, what do you look for in your portfolios?
Yeah. So our average door price is $55K, and our average rent is about $815 per month from Section 8. So price points. These are typically 3-bedroom, 1.5 bath, sometimes 4-bedroom, 2 baths. But the most average, the most typical property is 3-bedroom, 1.5 bath. And for that, we get around $800 a month in rent. So that's been our model. Fully rehabbed, occupied, property, the acquisition price is around $55,000.
That goes into this portfolio,
Correct.
And that's a stabilized property. And what I learned when I started investing out of state was that I look at these numbers like, okay, I could buy it for 20, and then it's going to be worth 75, but then the time it takes to rehab, the time it takes to find a good contractor, the time it takes to stabilize and put a tenant in. Most of us just see the end piece, which is great, which it's there, right? But we don't understand when you're not there and you're dealing with Midwest contractors and things, and you have no relationship with them, and you're a West Coast investor and they think you have tons of money. It's very difficult to get to the finish line without systems. So this takes away that, and you're also have an asset that's stabilized. And what are you guys seeing since you're doing a lot of Section 8? Are these tenants staying for a while? I mean, what's your average turnover that you see? Is it a 2-year span or?
We see between 3.5 to 4 years is the average duration that the Section 8 tenant stays in the house. There's myths out there about high turnover and problems. Yes, a lot of them are true. But what we have done is we've got a property management team, our leasing agents, our handyman that are really trained, to focus and work on Section 8 types of properties, work with Section 8 tenants. We have streamlined that process. So for us, we don't really get all that worried about turnovers and so on. Yes, it happens, and then every now and then you'll have a tenant who's going to cause some problems, but it's usually, it's usually the boyfriend of the tenant that causes the problem. The tenants are pretty cool, but they bring in a boyfriend who's going to cause to do deals and all that. So that happens. It doesn't happen all the time. It's not on top of our radar. When it happens, we deal with it. We try to work with them, and then we move them out. But it's not something that we stress about every day. The main thing is to treat the tenants very fairly, professionally, and then if they call in, because we have a local handyman, a local agent, we are able to take care of the issues, very quickly. We tend to use the same, if it's the HVAC system, whether it's plumbing, whether it's electrical, all of the same types of supplies go into the properties. We have a 7,000 square foot warehouse where we have our headquarters in Kansas City. So we've streamlined a lot of things. But of course, we didn't get there on day one. It took us several years to get to that point. But now, things are moving very smoothly. We are adding new investors, new properties. And then as the portfolio grows, the investors are getting, the same returns or similar returns, but across a much broader set of properties. So once we hit around 2.5 million, and then we'll probably close out this fund and then start another one. But for you, Beau, I like what you're how you're thinking about maybe even supercharging this for your investors. I think the price points are they would have to be above $70K per door for you to get that $50K loan, because there's issues with appraisals in the Midwest as well. Mm-hmm. But I think that. But if you do get leverage on these properties, then you can do even better.
Well, yeah, I mean, now because of the amount of institutional funds out there, like in our portfolio lending space that I'm in for my day job, it's just right now I'm refinancing my units, and it's like I'm putting 30-year leverage on it, or we have 10-year fixed product amortized over 30 years. So you can so I go in with, IRA money, people's retirement funds that are, know me and they like the deals. I put together a little valuation for them. Here's the pro forma. So the model works, and it's just a matter from there. Like you said, it's really, when you're investing out of state, it's really dependent on good management and knowing the areas to buy in, right? Where you're going to get the better tenant in there. I mean, there's always going to be issues with anything in real estate investing. Nothing's perfect, but I've never seen investment opportunities like there are in the Midwest, because you can go in with the housing stock, especially a lot of it's older. So you can go in and create huge upswings in forced appreciation by finding those deals. And there's a lot more defaulted tax properties and things like that. So you're able to kind of get good inventory. And it always blows my mind that for, a $30,000 asset I might pick up, that I can get $900 in rent sometimes, it blows my mind, and it's there. So there's a lot of, for people that are just getting started, I do see their pain sometimes as they're going. I talk to many people, and since I'm doing loans, I'm talking to them. And then I see a lot of successes. But I know if you can kind of create the winning formula, there's just endless amount of opportunity.
Yeah.
But to get the cash flow you want, you're gonna have to do a lot of them, right? You're gonna have to own a lot of doors, or have a lot of capital to deploy and put it into a portfolio like yours. So you have to start somewhere. So if you have cash, you have to use what you have. But So, and also what I like about the middle America type investing in the kind of the lower economic areas is that people need a place to live. And we're helping people by providing nice rental properties. We're helping our investors and we're helping ourselves, right? And that's great. And so, what other markets right now are you guys looking at doing a similar model? And I mean, what's your top two that you're looking at right now?
You're listening to the Investor Financing Podcast. We'll be right back after this break. Are you looking for funding? Are you getting frustrated trying to find a lender? Visit investorfinancingpodcast.com and click the Get Funding button. Complete the simple form and schedule a free phone consultation with one of our placement specialists. We have a proprietary directory of funding partners that can help you get the funding you need. It's fast and easy to explore the options available for your specific needs. Don't wait. Visit investorfinancingpodcast.com and get connected.
So we still like Memphis. We still like St. Louis. I personally, I have a turnkey operation in Cleveland. Milwaukee has been a good market. I would like to get into Texas, but it's just got priced out. The numbers are not really making that much sense unless you go into a really small, slow market. But I still like, the Sun Belt states, parts of, around Atlanta. But where we're focused is primarily Kansas City, St. Louis, Memphis, and then Cleveland. And we're going to stick to those markets, not because they might be the greatest markets out there, but that's because that's where we have trusted boots on the ground. We have the right contractors, we have the right agents, we have the right connections with the housing authority. We know where the vouchers are available, or where there's an abundance or access to the voucher, programs, the tenants with the vouchers. Sometimes you go into cities and the numbers look great, but there's no vouchers available. So that's another dimension of our business that we have to pay attention to. We like our model because, the tenant only pays between 10 to 30% of the rent. So usually they want to cooperate and pay their rent. So we're not having to spend as much time chasing rents as you would maybe, let's say, with a private renter. So that's what we like. But Beau, like where you are in Indiana, great market. I think you picked a great market. Land and expand. I would say just land and expand in that market until you get to 50, 60, 70 doors. And then you can pick, maybe you go to Indianapolis or Fort Wayne or something like that. But, establish your economies of scale, get a full-time handyman or something out there. But that would be, the way to grow that market.
Yeah, I just actually, before we jumped on this call, I got my year-end statement from my property manager, with all my expenses and income earned, and it's rewarding to see that, because there was a lot of hard work and sweat and tears kind of poured into this because things didn't always work out, but you definitely see the light at the end of the tunnel, and it's really just staying focused and realizing that it's not always going to go perfect and figure out what works and what doesn't work. And then, what I came to figure out as far as my investing model is, one is I'm not going to do huge rehabs anymore in the Midwest, just because until I find that perfect contractor, it's just difficult. Yep. So I want to find stuff that I can, within 30 days, be done with, right? So I buy it, in 30 days, it's rent ready. And it might take another 30 days to rent out. And also what I've learned too is pricing your rentals is so critical. I had a rental that I was at $650 a month and it sat for 2 months. No, $675, excuse me. The minute I dropped it to 630 a month, I got a tenant. So I spent 2 months. So I lost, 1,200 plus in rental income because of this oversight. So really pricing your rentals strategically, depending on location, size, and so forth, is critical because the idea is, I just lost $1,000 because I wasn't smart, right? And so that was a big learning mistake. Like, why is it renting? Why is it renting? Take action, figure out what that sweet spot is. Talk with your property manager. I mean, with your model, it's done for you, right? They don't have to worry about things like that. They're going to look at their quarterly statements and they're going to say, okay, this is, we're performing and it's looking good. And that's the extent of it for them, which is great. It's more, hands off, whereas I'm hands on.
Yep.
I'm going to continue to grow my portfolio there, but I do believe in having 2 or 3 investing areas for diversification for, natural catastrophes or different things like that. So it's kind of my focus is like finding different models.
The next good market. Yeah. I agree with you. Like, if sometimes we do worry about being like in a flood zone, or an economic downturn, if the city is dependent on like one industry or one big company, then those are not good factors. We want to be diversified. We want to be in at least 500,000 or greater kind of a city. But you have the university. That university is not going anywhere. It's growing. So you'll always have that demand. And because of the university, it spawns other businesses around there. So you're good there. But yeah, yes, I agree that maybe one day we should, grab a beer or something when you're in the Bay Area or I'm in Vegas, but talk about like, what are some of the other markets that have numbers that are favorable for rent ratio, good demographics, and then finding the right crew to run your property. So, but yeah, but those are exactly the same things that we look at.
Yeah, I think most investors that have a similar outlook. We all, in our minds, we all say, okay, how am I going to get to this 20 or 30 grand a month net cash flow every month?
Yep.
And then life starts to get a little bit easier and how do we get away from the grind? And to do this it creates that time freedom. That's what we like. I know you love to travel. That's kind of the goal. And I think, going back to the point of this podcast is to really look at different models, different financing models, like what's available for you, right? Like, and figuring out, okay, I can build a network of private lenders that will lend me 100% of purchase price, 100% of rehab. They'll get a first lien on the property. I go in, do my thing, stabilize the property. Property manager, helps with that, takes it over and get a tenant in there. And then the availability of capital now, which you don't need to, what I like about our lending programs, doesn't go on your personal credit report. The loan's made to your entity, your LLC, your corporation, right? So you're not getting dinged on your credit, right? You keep your personal credit personal and you keep this.
Very nice.
And so you can rinse and repeat. You can, pull out, pay your investors off. They get all their capital back. Now they're happy because you performed on your loan to them and they made a great return. Yeah. And then I find another one and invite them to lend on that. And I can keep doing that over and over again.
Yep.
With very limited cash out of my pocket, right? So as an investor, as a catalyst, right? I'm the one that's finding the deal, making the deal happen. I'm able to do that, and they're happy being a passive investor on the money side. So
absolutely,
there's just a lot of ways to structure the financing, and I think like your meetup and my meetup and things like that, like bringing in these speakers that can talk on self-directed IRAs and different things like that. So people that aren't in the business like we are, where we're meeting, talking real estate 24/7, they can quickly kind of figure out, okay, here's options. I have $400,000 in this 401k over the last 30 years that's not doing jack for me. Now I can put it in something like this and get an 8 to 12% return, or I can, venture out and try it on my own, but maybe I'll start with Bobby's model first because I get my feet wet, plus I get the advantages. In your model, they get the same advantages of owning real estate: appreciation, depreciation, right? And so forth. So I think it's a really unique model, which enables them to buy out of state. Yep. And kind of like get their feet wet and, sit back and let you guys do the heavy lifting.
Yeah, absolutely. So, so we designed this based on our own experiences, right? I've done rehabs remotely based on the experiences of our investors. A lot of our investors were private money lenders. They were getting a 1099 at the end of the year, no write-offs, and they were in the high income, tax bracket. And so they wanted something that's a little bit more tax efficient, a little bit where they get to participate in the appreciation, in the growth, but they didn't want to deal with, the tenants calling them or the property manager calling them or having to fly out somewhere and hire a contractor who's going to do 75% of the job and then bail because he picked up another project. And, so we took all those, the unpleasant aspects of owning real estate out of state. We took those out and we kept the benefits for our investors. And that's, with your model, that's perfect because that's what you're doing here. You've got private money lenders who need their money to work better than what's going on in the CD or in the bank or in the stock market or in bonds. Private money usually, if done properly, pays better than any of those. No headaches, easy paperwork, no credit impact. And then on the other side, the tenants get to live in a nice, fixed up property. And then you, on the other hand, you get to build your portfolio. And so, I think like you said, it's a win-win-win for everybody. So, I would say, I don't see any doom, I know there's a lot of doom and gloom, but our population is growing at 3 or 4% a year, United States population. So there's 10 million people being added every year in the United States, or a little bit more, and they need housing. So, whether, they choose to live in single family or multifamily, there's a need for housing. In the Midwest, like you said, there was a lot of defaults. There's still some good inventory available. It's getting chewed up by a lot of investors, and a lot of local people have now gotten smart. But it's getting, the inventory seems to be shrinking a little bit.
Yeah. I mean, that, it's happening everywhere. I look at when I'm refinancing my properties, what I paid for them, what they're refinancing at, right? Like there's definitely been a huge rise in gain, but there's still a tremendous opportunity to find these distressed assets. There's, in any market, even these appreciating markets, these markets that are super hot, even on the West Coast, right? We're seeing people buy houses hundreds of thousands of dollars under market value. I mean, they're good at finding these off-market deals, but there's opportunities everywhere. I mean, even if we go into a downturn, there's still going to be flipping opportunities. Absolutely. There's still going to be buy and hold opportunities. It's really just kind of knowing the market, not overpaying. Yep. Like there's a lot of talk about in a market like now, like if you look at the multifamily market, I think people are overpaying and there's unrealistic, like in anything, right? They're buying these properties with the idea that they're going to force appreciation by doing all these CapEx improvements, and the rents are going to be $200 higher now per door. And what I'm seeing in the lending side because, we'll get these people that have, they bought the property 2 years ago and they were supposed to be done, with a lot of improvements. Now they're coming back again for another bridge loan, right? So borrowing on a bridge loan on a multifamily for the second time, sometimes it's, well, how come your plan's not working, right? Like what's going on? So the money on the purchase side is a lot easier to get, but when you're trying to re-bridge it, and so I think we're going to see a lot of broken projects coming because people are overpaying and different. Same thing in the Midwest on the single family, right? People are thinking they can BRRRR. They're like, well, it's going to appraise for 100 grand when we really know that property is going to appraise for 75, right? They're not, because the Midwest, let's face it, is so much more challenging to comp properties in the Midwest than it is, like in California, it's easy, right? Yeah, it's easy. But the Midwest, just because there's a lot more older housing stock, and it's not as, I always try to tell people things move slower and it's not as fluid. So you're going to see a big difference. So like on the street, you could see a house that sold for 10 grand and 100,000. You're like, well, mine's the same square footage, but it's a completely different floor plan. It's completely different. One's original. So, that's one of the most challenging things, I think, for me too, is to really figure out what the actual ARV is going to be on the property. But like anything, it takes time, it takes work, and you really got to know these markets so you can project, especially if you're trying to be a BRRRR guy, right? A BRRRR girl, is that setting the right expectations of what the appraised value is really going to come in. Because a lot of people think for whatever reason, their house is always better than everybody else's house. It's going to appraise for more. And that's not the case.
Yeah, I mean, they look, So the biggest risk when I was doing my BRRRRs out of state, whether it was Huntsville or Cleveland or St. Louis, Indianapolis, was the appraisal risk. Like everything seemed okay. And then the wholesalers, they don't care. They're going to quote you in the highest possible ARV. They're showing you some comps that are at the top of the market. But then when the appraiser shows up, he or she's going to be nowhere near. So whatever you thought you were going to get out of refinance is not going to happen. The other thing is you got to season the for 6 months or whatever to get the full refinance value out. Sometimes people are not told that explicitly. They think they can go in, do a quick rehab, 60 days out, they can do a refi. A lot of banks are kind of tightening up on that. I don't know if your bank is tightening up on that.
Well, we're not a bank. We're a private fund. We're a private fund. So that's the other advantage of our portfolio loans is that we use new appraised value after 90 days. And then months 4 to 6, we'll take a 5% haircut on the LTV. So you can use new appraised value. So let's say you bought it for 30, you put in 30, and now it appraises for 100,000. We'll use new appraised value after 90 days, and then our LTV threshold for lending is 5% lower months 4 to 6. But so you're able to get 75% leverage. So you're able to BRRRR after 3 months if you do it right, with a lot less red tape, meaning we need bank statements and a PFS, personal financial statement, and we use a third-party appraisal company.
Got it.
We do a credit and background check, and our pricing is based on credit score and LTV, and whether it's a rate and term or cash out or purchase. And that's as simple as it is. We're going to see, like going forward, like the flip, obviously the last 8-9 years, the fix and flip loan business has just exploded. But all the funds came into the private lending space over the last 6-7 years because they saw, there's so much opportunity. Now, the rental loan programs that we're rolling out, like in the past, hard money was hard money. It was 10, 12%. I mean, now these portfolio lenders like ours are doing, rental portfolio loans up to $20 million. They're doing single family rental loans. They're doing fixed to rent loans where you get a fix and flip loan and then it modifies into a 30-year fixed rate, right? So there's so many options. And going back to the reason I'm starting this is to get guys like you and pick your brain, how you're structuring deals on the buy side, and then create these structures where it's like, I can achieve my cash flow goals that much quicker by knowing all these strategies, right? Yep. And I was just listening to a podcast yesterday about a guy who's, buying subject to. He's finding these properties, and it was amazing. He, got $20,000 a month net cash flow in 4 months by subject to. I mean, he's got a team and he's like super sharp. It's not like average Joe kind of guy, but it's when I heard that podcast, I'm like, you know what, with all the training and learning we do, the meetups we throw, plugging into like these systems, right? It's like, that's how it's going to work. Yeah. Yeah. And that's what we have to do. Right. And like anybody who's listening to this, get plugged in and just keep learning. Cause I learn something new every day. I never stop learning because there's just so many people that are so many people in our network that are successful where we're able to kind of like sit down and just kind of pick their brains and kind of the idea of these kind of podcasts and these meetup groups is to educate and to network and to, hopefully do business together and create long-lasting relationships. And I think that's the name of the game. I mean, I know it's never easy, whether you're flipping properties or buying rentals or building new construction or buying multifamily. You got to do the work to get paid. But I definitely get encouraged just seeing the growth of when you and Kent linked up and how many doors you guys have under that program, right? And all the other ventures you've done, and you're doing some multifamily deals and different things like that. So tremendous amount of opportunity. And I'm looking forward to our out-of-state REI bar camp we're going to host. And so we'll finish that, planning on that, and that'll be in the next 3-4 months. Yep. And anybody in the Bay Area, anybody who'd like to attend, I already have an out-of-state kind of turnkey provider that wants to come present. So we're going to have, hopefully, the vision of this out-of-state bar camp is that we're going to talk about different financing options, different markets, why we're investing in markets. We're going to get the area experts. You're going to meet the property managers. You're going to just, be able to hit the ground running, whether you want to, invest with Bobby and his model or find it, network with some of his turnkey people. That's the idea of this REI bar camp. And we've never focused on out of state for REI bar camp. That's why I'm like, let's do it, because I love out of state. I love cheap properties. I love cheap, high cash flowing properties. I mean, I do look at some multifamily friends of ours and I'm like, wow, they're just crushing it, right? But that's like a big leap, right? Like big leap. Buying a $30,000 or $50,000 house, we can all do that today, as long as you kind of find the right core four, as David Green says, and you put the right teams together and have the right financing.
Yeah, it's all about getting in the game, and mainly it's about not making mistakes when you get into the game the first time. Because if you get into the game and you make a mistake, you may never do real estate again, right? So I've actually just last night I met somebody on Sunday. I met somebody who did real estate. They timed it wrong. They got burned, and for 10 years they haven't gone back to real estate. So the key, the reason why Beau and my meetups exist is so that you can come in, you can, glean from our knowledge, you can borrow our knowledge, you can ask questions, you can network with others, but make sure you don't get off on the wrong foot. And, I think, there's so many testimonials or stories about how people have come to your meetup. They've learned so much, and they've taken what they've learned at the meetups and then applied it, but built the team and got advice and not done it in a vacuum. Those are the folks that do really well. So collaborate, participate, help, share, give, take, whatever it takes, but get into the game. To me, networking at your events and my events and other people's events is so important. That's why I'm, even after a long day, I get in the car and I drive out to Walnut Creek and hang out, and it supercharges me. And that's what it's all about. And you make friendships, you make connections, you do deals. So yeah, I hope, I think the bar camp's going to be amazing. I'm looking forward to collaborating on that with you, and let's make it big.
Yeah, that was awesome. I think we touched on a lot of things. We'll definitely bring you back on the show. But I'm going to end the show right now. Guys, you'll have show notes. You'll have links to Bobby's meetup groups and different links that he's partners in, so you can get a hold of him if you're not familiar with Bobby. But Bobby, stay on the line and we'll chat real quick. I'll just end this here. Thanks for listening, guys.
Thank you.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.